Bloomberg Audio Studios. Podcasts, radio, news.
Here's the latest this morning. President Trump calling for the Fed to cut interest rates once again, saying it's, quote, not fair to America after a soft CPI report out just yesterday. Former New York Fed President Bill Dudley writing the following: the Fed has little choice. When it doesn't know which way the risks skew, it must wait for more information. Right now, any major move would have only a 50-50 chance of a positive outcome. Bill joins us now for more. Bill, welcome to the program, sir. Why such a negative assessment of the position that they're in right now?
Because they don't know where the tariffs are going to land, number one. And two, they don't know what the effects of the tariffs are going to be on growth versus inflation. So they're uncertain about two dimensions. So they can't really just sort of flip a coin and say, oh, well, we're going to worry about the growth dimension, because that could turn out to be wrong. So they have to sit and wait for more information. I mean, if you were driving a car in a thunderstorm, you wouldn't just put the car on autopilot and hope that you would get through it safely. So you pull to the side of the road until the weather cleared up, and that's what the Fed has to do. The Fed is going to be criticized for waiting. They have to wait, and because they're waiting, they're probably ultimately going to be late. But it's not the Fed's fault. I would behave exactly the same way in this set of circumstances.
Bill, what's their definition of late, and what's your definition of late? Because he reflected on the move last summer, and he said, in some ways, we were a little late, and other people thought he was being preemptive. What's late to you?
Well, I think late is responding only after you've seen a sizable increase in the unemployment rate, because at that point it's really hard to avert a recession. You know, when I evaluate the risks to inflation versus the risks to growth here, I guess I worry more about the downside risks to growth. But the Fed can't put all their marbles on that side of the equation, because inflation has been running above the Fed's target for 5 years, and if they're wrong and inflation expectations get unanchored, then it's a really difficult problem getting inflation back down. So I think they have to wait. Because they wait, because they'll be forced to wait, they'll probably be late. Trump will blame the Fed for being late, but the reality is Trump created the conditions that forces the Fed to have to wait.
Bill, I'm just curious, going forward, how much you see the Fed unwilling to move, even if the unemployment rate rises by a 0.5 percentage point, which is sort of the trigger that a lot of people are looking at, if you do see those inflationary pressures coming back?
Well, I think if the unemployment rate rose by, above 4.5%, that would change the Fed's calculus. They would be much more worried about the self-reinforcing deterioration in the labor market leading to a full-blown recession. So I think the unemployment rate is really the single most important indicator. If it stays around where it is today, the Fed's going to just sit and wait. If the unemployment rate starts rising quickly, then the Federal Reserve will start to respond. But I think it's going to take some time. I mean, the hard data on the economy shows that the economy is still just fine. I mean, the first quarter GDP report was very misleading, because it was mainly the fact that they couldn't count inventories properly to match up with the big surge in imports.
Bill, if you were still on the Fed, and you have been on the Fed through crises and through really difficult times where the market was moving faster than the underlying economy, what data would you look at to get a real read on what was going on in the United States?
Well, I think some of the banks have actually pretty good real-time data in terms of what's happening in sort of credit cards, and they're not seeing much of a slowdown at this point. Initial unemployment claims, it gives you a pretty high-frequency look at what's happening to the labor market. That doesn't show any deterioration yet of note. So I think you're looking at things that at the margin that suggests that weaknesses are starting to accumulate. Now, what's interesting is the tariffs are actually starting to bring in revenue. So fiscal policy right now is actually starting to become tighter. And I'd also look at low-income households, because I think that's where the squeeze is going to be the most significant. So if you start to see delinquency rates on subprime auto loans really start to head up, I mean, they're already high. If they start to head up even more substantially, that would be also a sign of a growing strain on the growth side.
Bill, at some point the Fed will have to update their numbers. On March 19th, they put out these forecasts: GDP at 1.7% for 2025, PCE at 2.8, unemployment at 4.4. On June 18th, they'll have to deliver an update. When we get that update, Bill, what do you think it will look like relative to March?
I think they'll show somewhat slower growth to reflect the fact that tariffs have gone up more than they anticipated, and somewhat higher inflation to reflect the same consequence. So I think it'll be even a more pessimistic forecast, in the sense that the Fed will be missing both of its dual mandate objectives by a bigger magnitude. But they still won't have clarity on what's happening to tariffs and the impact of tariffs on the economy. And so I think it's going to take a while for that to be realized. And only then will the Fed be able to act.
One missing piece: slower growth, somewhat higher inflation. What does the median dot do, Bill? Because I think that implies what their reaction function is, how they'd respond to that kind of data mix. Do you think it changes?
I think that you can make the case that the Fed starts to cut rates in September, and maybe we could still get 3 rate cuts this year, which would be consistent with the March summary of economic projections. But yeah, obviously, as time passes and the Fed doesn't act, the likelihood is the median number of rate cuts starts to come down just because there's fewer meetings left.
Bill, appreciate your time, as always, sir, and enjoy your pieces on Bloomberg.com. On Bloomberg Opinion, the former New York Fed President, Bill Dudley there.